we're here at one of my listings at 4110 Meadowsweet St in Pasco, Washington, and it offers an assumable loan. We just had a broker's open today, and we were received with a lot of questions such as, what is an assumable loan?
So an assumable loan is where the buyer who's purchasing the property is just taking over the loan for the seller. They bought it likely at a lower purchase price. They've probably got a really good interest rate, and they maybe don't want that to go to waste. And so they allow a buyer to come in and just start making the payments on their behalf.
So what happens when there is a lower loan balance amount versus a really huge gap between that and the listed price?
Right, so in order to assume over a loan, a down payment isn't required. Like, the agencies don't require the down payment to be there. But if the seller wants to walk away with the equity that they've paid into the loan and the riding the market as the value has gone up, then the buyer is going to need to cover that gap, either with a down payment, or in some cases they might be eligible to get a second mortgage, like a HELOC or a home equity loan. And in some rare cases, the seller might be willing to carry the financing to help with getting the buyer into the door if they don't need that money right away, but they can maintain a lien on the property to get that money later. So there's a couple different options available, but the bottom line is the buyer is responsible for coming up with the gap between the loan amount and the purchase price.
Does the buyer have to pay closing costs?
There are still going to be closing costs. There's still going to be an escrow company involved. There's still going to be probably a title search. There's, in some cases, you might have an appraisal, depending on circumstances. So there's still closing costs, but you're not paying lender fees because, again, there's no lender involved in the transaction. A loan officer such as myself is not going to be involved whatsoever. It all happens through the servicer, which is whoever the seller is making their payments to. And so they're entitled to a fee. Sometimes it's 0.5 point, which is 0.5% of the loan balance. So yes, there's still closing costs. So the buyers should still be prepared, in addition to the down payment, to be able to pay closing costs as well.
So what type of loan can be assumed?
Conventional, off the table. If it's a conventional loan, which is 70% of all mortgages are conventional loans, not eligible. Government loans only. VA, FHA, and USDA.
My next question is, who can assume a loan?
The easy answer is anybody can assume a loan, but they still have to qualify with their credit and income. So the servicer is still going to run a credit check and collect documents to verify income and do all the calculations there. So not just anybody can assume it. But a lot of people don't realize that VA loans in particular, you don't have to be a veteran to assume a VA loan.
I see.
You don't have to be a first-time buyer to assume a loan. You just have to occupy it as a primary residence. So investors can't do it.
And good you mentioned investors, because that was my next question.
With investors?
Yeah. Can investors assume a loan?
Investors can assume the loan, but they have to live there. So if you invest in other properties, good for you. You can own other properties, right? You don't have to be a first-time buyer, but that's going to be factored into the qualifying, right? They're going to look at the rental income analysis for your other properties, just like they would if you were buying with a normal loan. But you have to occupy the property.
What happens to the seller if the buyer that assumes the loan defaults on the loan?
So that's a really important question, especially for VA sellers, if it's a VA loan. And the reason why is because when you go through this process, you'll do what's called a transfer of liability, which takes the liability of the mortgage off of the seller's credit report and transfers it to the buyer's credit report. However, with VA loans, VA obviously does that too. But when it comes to VA, the veteran's entitlement is what gives them the ability to purchase a home loan with the VA loan. And that entitlement stays wrapped up in that loan. So if a seller is assuming out their VA loan, then that portion of entitlement stays with the loan, and it might prevent them from being able to get another VA loan in the future if the buyer doesn't sell the house or refinance it. Even worse, if the buyer defaults on that loan, and they go into foreclosure, they don't make the payments. Since that entitlement is wrapped up, that gets lost. Just like with any other VA foreclosure, you lose that portion of entitlement for life. And so if a seller of a VA loan is assuming out their VA loan and the buyer is not a veteran and they don't replace the entitlement with their own entitlement, then if that buyer defaults, that seller will never be able to get another VA loan again.
What would happen if a seller fails to get a release of liability?
So a release of liability is usually a requirement by the servicer, but it's not required for the loan to go through. So theoretically, it's possible to go through this process without the release of liability. So if they manage to do that without taking that step, then if the buyer has a late payment, then it would reflect on the seller's credit report. If the seller is trying to buy another house, then that mortgage payment would be reflected on their credit report in qualifying for their next house. They wouldn't be able to claim that there was rental income because the other entity owns the property. So they're not collecting rental income to offset that mortgage payment like you normally can. So you definitely want to do the release of liability to make sure that A, it doesn't show up on your credit report, and B, it doesn't show up on your credit report, and C, it doesn't show up on your credit report. That was dumb.
From a seller's perspective, how would that be any different from a normal sale?
For the most part, it's going to be pretty similar. I'd say that the big difference is that the closing date is going to be a shot in the dark because it depends on the time frames of the servicer working through it. If you think about it, the servicer probably doesn't want to do this, like they don't have an incentive to do this process. Now, FHA and VA do have specific time frames that the servicer is required to follow to make the closing date transaction happen reasonably quicker, meaning they can't drag it on for 6 months or whatever. But there's still, like, obviously you want to have a closing date, but you just don't know if that's going to have to be extended or not. As far as closing costs go, I would imagine that they would be the same, but that would be mostly a question for the servicer. The seller wouldn't want to ask the servicer.
What are some other questions a seller should ask the servicer?
So the first is going to be, does the servicer allow second mortgages? Like I mentioned to you at the beginning, the buyer doesn't have to necessarily bring the entire down payment themselves. They can get a second mortgage to help cover the gap, but not all servicers allow them to do that. And not all lenders even offer that. And so if they do allow it, do they offer it themselves? Can they do this in-house? Can you provide the buyer with this service yourself? Because not all servicers are lenders. Oftentimes they purchase the loans and make the service loans. But it's kind of like property management. Property managers don't necessarily own properties. They could, but they don't necessarily do so. And so asking them, do you allow second mortgages? Do you offer the second mortgages in-house? I would imagine that offering them in-house would be a more streamlined way of going about it. But if not, do you allow an outside lender to come in and provide this service to buyers? And that is the only time that I'm able to be involved. I can be involved to make that second mortgage because it's a new loan. I'm a loan originator, and a new loan is being originated. But the servicer may not allow it in the first place. So that's the first thing you want to clear the air with. Another question to ask is, will this need to go to the Department of Veterans Affairs or the Department of Housing and Urban Development? Department of Veterans Affairs is obviously for VA loans. Department of Housing and Urban Development oversees FHA loans. So does this file need to be individually reviewed by these entities, or can we just go through the servicer? Some complex files might need to be reviewed by these agencies.
So how does the second mortgage work?
Well, there's two main types of second mortgages. You've got HELOCs and HELoans. HELOC stands for Home Equity Line of Credit, and a HELoan is Home Equity Loan. And the line of credit is very unique because it acts like a credit card. Say you take out your, whatever it is, $50,000. When you pay that balance down, you'll have access to that funds again. When you're purchasing a home as an assumption, you're going to start off the loan at the max balance, and then it's typically an interest-only payment for the first 10 years. And what that means is your minimum payment is just going to be interest. It's not digging into principal. So this can be dangerous for some people because if you don't have that financial discipline to make extra payments, then it's not that you're going to be underwater, you're just not going to make any progress with paying off your debt. And so that's just something to watch out for. Typically, they might have lower rates than a home equity loan, a second home equity loan. That's more like your standard 30-year fixed. But the reason why you have to do these second loans is because these FHA and VA and USDA loans, they are required to take first lien position, meaning if the buyer defaults on the loan, that lien position is who gets paid, the order of who gets paid. So if you have the first lien, then you get paid first. The second mortgage, if there's money left over, gets paid. If there's any money left over and there's a third lien, then that third lender gets paid, right? And so there's inherently more risk to the lender if they have to take a second, third, fourth lien position. And that's why the rates are typically higher. So when you're judging whether you should get the second mortgage or just get a new loan, the difference is going to be how much is the balance and the interest rate on the loan that you're assuming, and how much of a gap do you need to cover, what's the interest rate on that, and then comparing those numbers, because in some cases, if the loan amount is low enough that you're assuming, sure, it's a great rate, but that doesn't mean that you're going to be paying less. So that's just all part of calculating the cost benefit, and it might be worth it to just take a 6.5% mortgage with a new mortgage.
And probably even negotiate for the seller to pay part of those points to get that interest rate down.
Yeah, you can ask the seller to pay discount points to drop your rate. You can ask for the seller to cover a 3-2-1 buy down or a 2-1 buy down to get you that temporary interest rate while rates continue to drop over time. You can refinance that and use the leftover funds to do that. There's a whole topic on that. The seller can pay for closing costs, right? It just depends on what's negotiated, right? Everything in real estate is negotiable. And if the seller needs to sell the house, then they're going to do what needs to be done to get that property under contract.
So the buyer really needs to do their homework on this one in order to figure out which is best for him.
Yeah, the seller definitely needs to do their homework and make sure that they are in constant communication with the servicer before they even list the house, or at least before they advertise it as assumption eligible.
Correct.
So lots of communication with the servicer before, lots of communication during and after, and the buyer needs to know what's going on too and what the ramifications are of taking over somebody else's mortgage.